My name is Britton Williams, financial advisor at Calamita Wealth, along with Todd Calamita. Um, this is the Wells Fargo 2025 financial calendar for you all. We did this a year ago and made some updates to make sure it's available to everybody again this year. And I just want to point out some actions to take that are important dates over the next year. Yeah, stick around. We'll provide you a copy of the calendar at the very end. Provide you that via link or email. Our contacts in the chat. There's a couple of helpful links that are in the chat. We'll bring it up along the way, but one of them is our direct contact. If there's something that you want to ask or talk about one-on-one, feel free to set that up. There's a link to our Calendly, and yeah, let's get started. And just some housekeeping over the next several slides. We'll stop and pause for questions and answers. We want to make this as interactive as possible. If there's something on your mind that we're not covering, please bring it up. You can put it in the chat, raise your hand, or just speak up, and we'll get to it at those pauses. All right. So first month of the year, January, just to keep in mind the updated 401k contribution limits for 2025 are as follows. You contribute $23,500 or the catch-up of $7,500 more if over the age of 50 for 2025. That's into your 401k. For the traditional IRA and Roth IRA, combined, those limits are $7,000 and $8,000. If they sound familiar, they did not change. Again, these limits are typically based on the CPI inflation. So just every year we want to keep a pulse and see if there's any changes. And we're going to touch on the HSA limits as well, but that's in the chat. All right. Well, let's jump into 401k contributions. So you're going to get your bonus around February. Your incentive bonus, cash bonus, restricted share rights, combination of the two. And typically you receive a notification of making adjustments to the 401k contributions. I've got clients who they bring it up, and some years that they remember to do this, some years they forget to do it. And we're just want to bring it to awareness that you don't have to do this, but just a reminder that you can do it, and a couple snapshots in Empower of how to make those changes. And so what we're doing here is we're adjusting just that one pay period for the contributions of when you receive the bonus in February. And so you want to go to Empower, go to contributions, and over to the right, you'll see where you make an adjustment to just this date of submission. So you fill this in, and then a one-time only, then revert back to the current rate, and then click save. So it should just change it for that one contribution. And again, you should be receiving a notification about this, usually a couple pay periods beforehand, because it does take more than one pay period to take effect, which is why a lot of people will miss it. Now, why would you do this? Well, if you're going to get a bonus that encompasses maybe 30% of your annual pay, which is common for Wells Fargo employees, is that you may contribute the entire year's worth of the 401k in that one pay period, which isn't a bad thing. I can make a case for doing that and not doing it. But there's also a case of kind of spreading out throughout the year to capture different market price points, as well as it might be better on your cash flow. So again, specific to everybody, not direct advice, but just to be aware of what you can do to make those changes. All right, so I'm going to hand it over to Todd, talk a little more about the investment side in the 401k.
Yeah, thanks, Britton. And also we have a few people that are still joining, so if you I think we just need to admit them, Britton, if you don't mind keeping an eye on that. Yeah, so I think most of you are probably familiar. At the end of the year, Wells Fargo provides your match in the 401k, and this is a snapshot of what it typically looks like. So on the last day of the year, there's going to be a line item that says Wells Fargo ESOP fund, and essentially that's just Wells Fargo stock. So what you want to look at is we have clients who've been at back to when it was Wachovia, and they have Wells Fargo stock that's built up over the years. And so what you don't want to do is let this become, say, 20-25% of your portfolio, because you're taking on additional risk than you really need to. As an employee of Wells Fargo, you have a lot of kind of your eggs in that basket. You have your bonuses. So what my wife works at Wells Fargo as well. And one of the things that we do every year at the end of the year, we go in here the first week of January and we just diversify out of the Wells Fargo stock and put it into a regular allocation. Really, if you keep it in there, it's a decision to buy Wells Fargo on that day. So if you're not planning on buying Wells Fargo, then you probably want to just diversify out of it. You're probably taking unnecessary risk. And I'm not just speaking of Wells Fargo stock. This would go for any bank stock, any individual stock where a company matches with that stock. So we like to diversify out of it. And, unfortunately, we've seen some of people before they start working with just let that build up, and it just puts them in jeopardy of, a lot of fluctuations in that portfolio, which we want to try to avoid. Anything to add to that, Britton?
No, pretty straightforward. Again, if you all have any questions, you can put in the chat. We'll get to it in a minute.
Okay. So how risky are target date funds? So this is I don't want to say it's a somewhat of an overlooked conversation that we find, is that these dates in theory on the left. So if you're in the one of these target date funds, in theory they're supposed to match up with when you retire. Okay, and that's fine. That might work in some cases, but what we want to encourage you to do is kind of look under the hood with these target date funds, because they're not all the same, and you want to understand what type of your risk you're taking. So I'm going to start sort of down here at the bottom with the 2065 fund. We'll just call this Larry Long-Term Investor. So in this case, this 2065 fund is made up of 90% stocks and 10% bonds. So this is really what you want to look at, not just the date, but understand what you're invested in and what type of risk you're truly taking on, because it may or may not be appropriate for you regardless of when you're retiring. So in this case, 90-10, what that might mean is that might mean a 30 to 40% drop in the portfolio at any point in time. And it's probably not a if, but a when. So if you're invested that much in stocks, you're going to see some type of drop in the portfolio to that extent at some point in time. So you just want to be aware that could potentially happen. And are you comfortable with that? Everybody's comfortable on the upside. It's really the downsides you want to look at. So what we see some people doing is looking, especially over the last couple of years where the market's been, doing really well. They might say, oh, the 2055, 2065 fund have done really well. I'm going to move all my money into that. Well, that doesn't really tell the whole story, especially in a down market. So if we flip here to the other extreme and look at the State Street 2020 fund, the underlying investments are 30% stocks and 70% in bonds. So again, this is an entirely different makeup than the 2065. So you're not going to see the type of fluctuations you would in the 2065 fund, in a 2020 fund. So in this case, you might be looking at a 10 to 12% drop in the portfolio if you had a really big downturn in the market. This isn't exact, but just to give you a gauge, it's going to be a big difference than the 2065 fund. And if we kind of look here at the 2035, we'll call her Maggie middle of the road. So that 2035 fund is equivalent to 70% stocks, 30% in bonds. Again, encourage you to look at that allocation and sort of that downside. So even with the 70-30, you're looking at potentially 20 to 25% drop in the portfolio. So that may or may not be appropriate for you. What we really believe is that you do not want to take any more risk than you need to. So there's sort of two things. There's risk tolerance and there's risk capacity. Risk tolerance might be you're very comfortable with the 2065 fund, but what's your risk capacity? Do you really need to take on that type of burden to meet your goals in the future? So if you can minimize your risk as much as possible to still meet your goals, that's what we're typically aiming for. Anything to add there, Britton?
Yeah, just to kind of go back to your point in the beginning that no, all you're seeing this target date funds that are available to you in the 401k. That every 401k, if any company has these available, they're not all treated the same. They're very unique underneath the hood. In other words, so some of you may be more sophisticated than others to create your own portfolios, or maybe you have some guidance from an advisor. That's great. But the average investor doesn't. So that's what these are really great for, to kind of simplify the purpose of the account and invest it toward a date in time, which is retirement based on your age. But that doesn't mean that it's ideal for you. So there might be needs to have a different allocation, as you get closer to retirement, maybe a portion available in cash. And everyone has a different need. So I want to make sure that's important, that we're not giving advice to buy these. It's just to be aware of like the different types of risk associated with these dates that you see and kind of what's underneath. And mechanically these funds have to rebalance every quarter, and what they're buying and selling can be different from another target date fund that's of the same date. So one may have more or less exposure to international stocks or different sectors. Just to be aware of that. All right. So we're going to pause here. I know everyone kind of just joined. Maybe you're coming in from another meeting. I know Wells Fargo keeps you very busy. And just take a pause if you have some questions. You can go and post it in the chat. You can raise your hand, just speak up. I think we may have already some questions queued up. But yeah, let's give it a minute.
Yeah, feel free to unmute yourself there. Again, I want to make this really as valuable for you as possible. So any specific questions you have, just come off mute. We could chat, drop them in the in that chat bar as well. Well, while we're waiting on putting some questions in the chat, we do have a couple that kind of came in earlier. One is from Deborah, and the question is, when do I need to take out of my 401k? Can I roll this over to something else? What and when should I do this? So, very common question, and the answer is, you have to take money out of your 401k at age 73. If you're born before 1960, that won't be till 75. And those are essentially your required minimum distributions. Yes, you can roll this over into something else. In order to not pay taxes, you would roll it over into an IRA account. And oftentimes we see people doing this, when they retire or right before they retire. I think you're eligible at 59 and a half to do that at Wells Fargo. But typically people want more control. They want to consolidate things, especially if they're going to be withdrawing money from the account. They want it to be sort of coordinated among all of their assets. So it's just an easier option to do. So that's so that's a couple options with the 401k. Main thing is the RMD. You're going to have to make sure you take it out then. See, we got anything else? Any other questions before we move on? See, so one other question that came up from Eric here. So I think one of the things he was doing was comparing his 401k returns to money he had somewhere else. And I think it was in another 401k he mentioned. And he's saying, should I move my money? Well, I think the real point about that is you got to compare apples to apples. So one of the things Britton was saying earlier is that target date funds are not created equal. So you might have two different target date funds, and they do differently. So you shouldn't necessarily move it just because one is doing better or worse than the other. It's really digging in and seeing why, because usually there's something there that's different between the two funds. Could be even something as large as or as big as one's the international fund and one's a US fund. So they're going to perform completely differently. So you just want to make sure it's on par with what it should be doing. So again, we see that quite a bit. And just again, just look under the hood there, and we're happy to answer any questions if you're seeing differences on your end of what might be going on.
All right.
I don't think we have any more for right now, Britton. If you want to, kind of move on to the next one.
Sure. Yeah. Kick it off, Todd.
Yeah. So here in February, what not to do with your bonus. So this is, what we find is that, the kind of these things on the image here are probably going through your head, like, what do I do with this bonus, right? Do I pay down my mortgage? Do I put it in the 529 plan? Do I contribute to my HSA? What about my IRAs? When should I fund those? I want to retire early. Maybe I should put money in a brokerage account. Or maybe it's something like, hey, we want to go on vacation, or there's some home repairs or upgrades we need to do around the house. So a lot of this is floating around. And typically what we see is starts to float around, usually, a few weeks before or a month before, when you're kind of getting the notification of, what that bonus amount is going to be. So really, what not to do with your bonus is to make that decision, with those 2 weeks before, that month before. Really, what you want to be is strategic about this. And this should be part of a longer term strategic plan that you already have in place, not something that just, came up out of the blue. So for an example, we have clients where, they plan to retire, let's just say in 10 years, but they have 15 years left on the mortgage. So we have a strategy in place to pay off that mortgage by the time they retire. So we know a portion of that bonus already is going to fulfill that. That's where that money is going. Same thing with like a brokerage account. So we have some clients that they want to retire early, and they need to build up that brokerage account to give more flexibility to retire early. Or we have a target for the emergency fund, and it's been depleted throughout the year. We know it stays at X. So we know that bonus is going to put that towards that emergency fund to get it up where it should be. Again, this goes back to, it's all about having a long-term strategic plan, so you're not making decisions with such a large amount of money on a whim. So the focus is really on putting something together ahead of time and not being pulled or drawn in one direction at the last minute. So this is really important. This is something that everybody should be doing in terms of looking longer term instead of just at the short term, short term things. Anything to add to that, Britton?
Yeah, I think that there's so many different things on the screen that Todd just mentioned, and everyone has a certain right size to how to spend their money. And, it should come also back to your life. I know how hard you all work at Wells Fargo. So like the vacation might be important that you never take. But then there's like, that need to respect, like, okay, the financial objective of like paying down the mortgage. Maybe it's a higher interest rate. Maybe it's an ARM that's going to re-rate it to a higher rate. Or maybe it's just like Todd mentioned, catching up on retirement savings, whether that be in the 401k or the taxable account, or it's ideally a combination of all of them. But at the end of the day, the money that you're making, it should at some point, bring joy to your life. So like, I think there is a case to have some, like whatever that is that you may like, the experiences, if it's vacation or something else, having it towards a goal that's going to bring you excitement. Because there's things that responsibly we need to take care of, like debt and pay that down. Revolving debt like credit cards, high interest, absolutely pay those down. HSAs, we're going to talk about that in a slide or two about just how big of a benefit that is to contribute to. But I think it's having a strategic approach, like Todd said, and a plan in place and process to follow. All right, let's move on to, as I just mentioned, to the health savings account. Todd's going to talk a little bit about contributions and investments benefits.
Yeah, thank you, Britton. In the meantime, if you have the link to the Optum Bank website, if you don't mind just dropping that in there. So, this is how to contribute directly to your HSA account. And I have to admit that this is something I'm almost embarrassed to admit it, because I didn't realize this for a number of years, that you could contribute directly to an HSA account. outside of your payroll. So typically what happens is, October, November comes around, you're selecting your Wells Fargo benefits, and they're asking you, well, how much do you want to put in your HSA? And if you're anything like me, you're like, well, okay, I'm not sure, I know I want to max it out, but should I put it all in now? We don't know what our expenses are going to be throughout the year, if we're going to have to use it or not. So there's really three ways to contribute to the HSA. The one is payroll, as I mentioned. The second is going to Optum Bank, and I think Britton just dropped that in there. Logging in,
Yep.
if you haven't done so, that'll tell you the balance in there. And then it also gives you this is a snapshot of what it should look like. I know they just made some changes to the website. So it should be a contributions drop down, and then you have the option to make a one-time contribution. So this will link up to your bank account. You just go in and make the contribution. So people like doing this because maybe they just want to, for cash flow purposes, not take it out of their monthly or their monthly paychecks, and instead just do it right out of bonus and do it one time. And I think you have the maximums there, Britton, if you
Yep.
want to drop them in there. So as an example, for 2024, it was 8,300. If you're over 55, there's $1,000 catch up. And then they are going up for 2025, 8,550 plus $1,000 catch up. And, this option to directly contribute is really nice. If you haven't maxed out for the year yet and you want to, you still have a few weeks to do that. You could just go in here and make that extra contribution to it. So, and then really the third way, instead of doing it directly or just from your paycheck, is just do a combination of both. So you might say, I'm going to do a couple $100 every pay period. And then at the end of the year, at bonus time, I'm going to true it up and max it out. So this is a great little hack if you haven't done it. I know it gives us a lot of flexibility, and we really like, making this contribution directly as opposed to being limited to just the payroll. So the other thing about the HSA is it is one of the best investment vehicles out there. This is not really talked about much. It offers a triple tax benefit. There's no other investment vehicle that does that. So the money goes in pre-tax, it grows tax-free, and then the withdrawals are tax-free. So if you really think about that, even a Roth that grows tax-free and you could take money out tax-free doesn't give you the benefit of putting it in pre-tax. So it's a really phenomenal benefit. On the next slide, we're going to talk a little bit about investing it and kind of that growth piece of it.
Yeah. Just real quick, you have until you file your taxes. Thank you also, Dolan, who brought that up. I think you mentioned you have a couple weeks. So the HSA contributions you do have until you file your taxes, or April 15th.
Yeah, thanks, Britton. Yeah.
So many little rules to keep up with the IRS. Okay, go ahead, Don.
Yeah. So how to invest your HSA? Again, this is often overlooked. So we talked a little bit previously about that tax-free growth. Well, if you're not investing it, you're really not going to get the advantage of that tax-free growth. So one of the things you can do in the Optum account is there's a drop down called investments. You go in there, and then there's a few options below that, as you can see here, HSA to investments. So what this is doing is once you have accumulated over $2,000 in that HSA account, anything over that you can start to invest in. So because of the triple tax benefit, we typically encourage people not to touch this until retirement, because you have the benefit of this growing over the years. You can even, once you set up the investments, you'll have options similar to the 401k where you have your choice of how do you want to invest that. I'm not going to get into that, but just know there's quite a few options in there. And then you can also set it up to automatically move money from sort of the cash bucket to the investment account for every dollar that goes in over 2,000. So you can kind of set it up and forget it. And every time you contribute there from your paycheck or directly, it'll just go over to that investment section of the Optum Bank account. So really a great thing to know for that long-term growth. Obviously, this can only be used for medical expenses, but in retirement, you'll have plenty of opportunity to use that for various expenses. Anything to add there, Britton?
Yeah, it reminds me of a client that I was working with, and they wanted to retire, but the big impediment was the private health insurance cost that we all know is going up and up. But outside of what you're paying with the group plan and even Cobra, it's going to be higher potentially. And this is then you realize he had like tens of thousands in the HSA, so he was able to retire a couple of years early, knowing that this could fund that goal. And so this is can be earmarked to that specific reason to fund early retirement possibilities. Because all too often I see people wanting to push off retirement till 65 for the sole reason that they will be on Medicare. And maybe you don't have to do that with or without the HSA, but this, of course, would provide the funding, and then you can kind of plan ahead to boost it. But really, it's the investments that's going to possibility that could potentially get you to that point. All right, so let's jump into a different benefit: RSRs, RSUs, restricted share rights, units, restricted shares. So many different semantics for what we're talking about. Is just like the shares that are granted to you from Wells Fargo. Some of you may receive, some of them you may not, and they accumulate over time and different price points because it's all based on what the price was at that time. And the purpose of this slide is just to talk about like what to do with them. And it goes back to what Todd talked about with the ESOP portion. It's just like any other individual stock, but especially one that from your employer that you're receiving, that you're already kind of pegged to the performance of that company. They're giving you this restricted share rights because it's first of all, it's going to be seen as a decision to purchase the shares if you're going to keep these shares. So keep that in mind. Like ask yourself, will I buy Wells Fargo once these shares vest at that time? Typically, with my clients, we're going to move those shares over and rebalance it into the portfolio, especially when the markets at all time high, stocks at all time highs as well. It's going to support that. Now, that doesn't mean it's not going to go higher or maybe go lower, but yet everyone's plans and risk is unique. So it goes back to also, risk tolerance and risk capacity that Todd talked about. So what are you comfortable with and, how much risk you need to take? Now, I've got an example I like to share with a client a few years ago. He came to me when it was fall 2021, and he had almost 30 or 40% of his entire portfolio in individual Wells Fargo stocks. Over the years, he got accumulated a lot of these restricted share rights, and it went up and down, up and down. But at the point of 2021 fall, the stock had reached another all-time high around $60, and he wanted to sell then, but he'd already come back down from that. So he had an emotional tie to that stock. And the reason why this is important, that he wanted to retire early, he's in his mid 50s, and all the other money that he had was in 401k and IRAs, which of course he can't touch until he's over the age of 59 and a half. Now, ideally, also from a tax perspective, he can use these Wells Fargo shares as a source of income in early retirement. And because he wanted to wait to sell the stock at a certain price point, we weren't able to tap into that income from the taxable account, from this brokerage account where these shares were held. Of course, as you may know, the stock dropped 30, 40+%. And then we had to wait until the stock came back. So we did another thing called a Rule 55 and took some money out of the 401k. It's a loophole. But anyways, I'm going to get into that. But the purpose is, by holding too much individual stock, any stock really, heading into retirement can jeopardize the plan, because that's typically, especially if it's in a non-retirement account, for the purposes of maybe pulling it out for early retirement income. Again, everyone's situation is unique. This one is specific to somebody who is in their mid 50s, and so we want to look at where you are and how best to use these shares for your plan. But overall, I think the purpose is the takeaway is like, is it down to like the risk that you're comfortable with, and also how much you need to take. And, as I've said, usually we'll rebalance these shares into the rest of our clients' portfolios just to kind of get into that allocation, just like we do with the ESOP portion. Again, this isn't an advice to leave this call and buy or sell the stock. If you want to talk one-on-one about that, please let us know. Anything to add, Todd?
I think the only thing is just emphasizing, really what we're looking at is what's your probability of success in retiring. And we've seen it time and time again. Anybody that has a large concentration in any single stock, it reduces their probability of success. And that's one of the big metrics we look at. So, there's no reason to take excess risk if you don't have to. There's nothing magic about the Wells Fargo stock per se. So, just again, going back to that emotional tie, don't get sucked into that emotional tie just because you work there. You have a lot of your eggs in that basket already.
And then Todd just put a link in the chat, looks like to an article that we wrote that goes through a lot of the different scenarios and tax implications of the RSRs.
Yeah. So thanks, Britton. That's the most common questions we see about restricted share rights. So that's a pretty lengthy article. Probably if you have any specific questions that maybe we didn't hit on here, you'll probably find it in that article. Again, feel free to contact us. We can chat with you about it more.
Okay, let's pause again for questions. Feel free to put anything else in the chat, comments, questions. Maybe you had some things on your mind before you came to the call that you want to ask.
Yeah, I'm going to go back. I think David had a question here previously that we missed. So question is, could you speak to the benefit of the Wells Fargo matching contribution? Yeah, I think if you may want to, if you want to elaborate on that a little bit, feel free to come off mute if you're still on. But yeah, the matching contribution, you certainly want to take advantage of that matching contribution. I mean, you're getting a dollar for dollar. I mean, that's kind of a no risk, no risk for you other than, just being careful about letting that Wells Fargo accumulate because that's how that's how the match comes in at the end of the year. I see some people say, well, I'm only going to contribute up to the match. So I also think that's something you want to think long and hard about because you're getting pre-tax dollars going in, or if you're putting into the Roth, you might be getting Roth dollars, and it's really payroll deduction through the 401k is one of the best ways to accumulate wealth and one of the easiest ways. So maxing out is typically what we suggest, although everyone's situation is a little bit differently, but 9 times out of 10, that's what we're aiming for, is to max out the 401k and not just stop at that match. But David, yeah, if there's more detail you're looking for, if I'm kind of off base on that question and what you're alluding to, just again, come off mute or drop it in the chat. Who else? What else is on your mind? I think we're running ahead of schedule, so we have plenty of time for additional questions here.
All right, let's bring it into the final slide or so. I mean, this is December. It's the end of the year. You've got some time to do a couple different things. You've got the 401k contributions. It's a little late to make these changes, but just to be aware that you can make the 2024 contributions, but it usually takes about 2 pay periods. I honestly don't know if you have time or not to make that change to make the contributions max out. But at least planning ahead for next year, a lot of times people are tracking to contribute throughout the year. Maybe they're behind, by a little bit. This is the time to true that up. The other thing is the HSA contributions. You can go into opt-in bank, and this is more about like being on track for each respective year. As I mentioned earlier, you could wait until you file, but from a cash flow perspective and maybe getting it invested in earning power, you do it as soon as possible. Again, you go into the opt-in bank website, you can contribute outside of the payroll system to do that, which you can't do for the 401k. So it is a nice benefit to do that. The other thing is, and this isn't saying you need to make tax payments, by all means, advise from your CPA or EA is going to be the source here. But some people do have the need to make estimated payments by, to avoid the penalties if you've maybe have some capital gains and then withhold enough throughout the year. But usually if it's just simple, straightforward W-2 withholdings, and you may not need to make an estimated payment. Typically when you run into the need to do that, you've got two different sources of income, maybe a business or something like that plays a role, other source of income for your spouse, or like I said, capital gains. So you may want to make run this by your CPA before you make any payments. But one of the things that I see that comes up with clients, if they do end up having to pay every year, then that there might be a need for that. So Todd, anything to add on this?
Just the only thing I'll add to that last one about the tax estimates, we will be doing another webinar in March, and we usually focus pretty heavily on taxes at that time. So I think that's a real popular webinar. We do this will be the second year in a row we're doing it. And one of the things that we talk about, this alludes a little bit what Britton was saying, if you have, especially with the, with a couple, they may have different withholdings for each of their pay stubs based on their income. But really it's an average of the two. So even if you have a lower income earning spouse, they're going to be taxed on average at the same rate as the higher earning spouse. So there is a way to sort of back into, what you should be withholding, or making sure you're withholding enough on each person's paycheck. So what we try to do is, if let's just say your average effective tax rate is 25%, then, we'll show you how to look at your pay stubs and your tax return, figure out what those numbers are, and then make sure that you're on track, or, withholding the right amount. Sometimes the CPAs don't, just don't have the time to kind of focus on those sort of things. But, we do look at taxes pretty heavily, because there's a lot of strategic planning you can do around it, a lot of ways you can save on taxes now and in the future. So we'll jump into that and dig into it in March webinar.
Yeah.
But yeah, we do have time for a few more questions here. Again, you come off mute if you'd like, or drop it in the chat. Anything that was on your mind that we didn't cover, happy to chat about it here. And I did drop the financial calendar download in the chat there, so you can download that. I think I've listed about 40 different tips for 2025 of things you should be looking at month by month. Yeah, you're welcome, David. Thanks for joining us. Anything else, Britton, on your end before we wrap it up?
Just the kind of the theme is coordinating so many different areas in your life that impact you financially. You've got cash flow, you've got investments, you've got tax, and you've got estate issues that come up. And whether you're doing it all yourself, or you're working with an advisor, or looking to find somebody to work with, you want to make sure you find somebody to help you with all the areas that impact you financially, not just one silo. And so this is, we try to identify different touchstone moments throughout your year with these sessions. And like Todd said, we'll touch on tax in a couple of months.
Okay, well, I think that's it. If we have no more questions, we'll wrap it up here. Y'all have a great weekend, a great holiday season, and if we don't talk to you beforehand, hopefully we'll see you in the the March webinar. So look out for a invite for that as well.
Thanks
Take
for
care,
coming,
everyone.
everybody. Happy holidays.